Hello friends, today we will talk about backtesting of a particular strategy that most of you are already aware of, that is using markers along with opening range. In the previous videos and also in our webinars, you already are aware we have discussed about the markers of our platform 915 trade, and then you also know the opening range. We have explained the strategy, we'll explain it again. We will see how the backtesting results would appear for one entire month. Now for that we will go to historical data. We'll start from the 1st October. We are taking entire October month's data and then we will show markers. We need to, obviously because we are using markers, we need to show new markers. Now the strategy itself is quite simple. You automatically get opening range, you get strike wise lines and markers and candles. All of this you will get it automatically. What we do is in the morning hours, we take call buy only from opening range high and put buy only from opening range low. Okay, we don't take put buy here and call buy here in the morning. Morning hours, the opening range high should be broken and it should come with blue markers. Opening range high broken with blue markers, we take a call buy from there and then we try to go at least till the next strike and see if we can at least exit near the next strike. That will be our target. At least 30, 40, 50 points is what we try to target. Similarly at the bottom, you need to have pink markers, low broken, we take a put buy and go next strike. Since this is very nearby, we will try to go the strike after that. This is only 15 points maybe. So we'll try to go 40, 50 points or the next strike. That's how we look at it. The stop loss ideally we take is the previous swing low, if that is the nearest, or if there is a strike in between, we take that. Since this is too close, we don't consider the strike itself as a stop loss. We consider the low. For example, this can be my stop loss, for example. Similarly, in the case of put, we consider the initial stop loss as the previous swing high, or if there is a strike around that 15-20 rupees, we'll take that strike itself as our stop loss. So call buy from here and put buy from here. And then for the second or third trade, when the price goes away at least 40 to 50 points away from the opening range, and then while coming back, we need to have a lot of pink markers. If we have pink markers, then we take a put buy from here, go till either the opening range low or the strike after that, whichever has 40-50 points, we'll try to go till that at least. Similarly, the price should go at least 40-50 points away from here, while coming back should accompany with a lot of blue markers, and then we take a call buy, try to go till our next range or the next strike, whichever makes sense at that point in time. We try to go at least till that. That's how the strategy essentially works. Now what we did is, following the same rules, we did a backtesting of this strategy for an entire month of October, and what we have is this data. So we obviously, this data is available to you in the description. You can see the same data where we will share. We need you to obviously verify this yourself and see the kind of rules that we have followed and see if you are able to get the same results and if you could repeat this in real time. Date is obviously which date it is, the entry and exit time, and the strike, which strike we are taking. Most likely they are all ATM strikes only. We would not have taken anything other than ATM strike. It's only ATM strike. Worst case scenario, one strike above or below it might have been, but most likely it is ATM strikes only for all the entries. Then call buy or put buy, depending on blue markers, pink markers, and whether it is at ORH or ORL. Easy to understand. You then get an entry price of that, obviously, the options entry price and options exit price. Then we also have gross profit per lot. Per lot is exit price minus entry price multiplied by 75, and then it is gross price. That means we are not taking out the brokerage as well as taxes etc. from this. It is gross profit. And then you also have gross profit at 15k. Now what is this? We always, as an options buyer, you are already taking a lot of risk, because if the trade doesn't go in your favor, you would obviously end up with a lot of heavy losses and it breaks your capital significantly. But when a trade works, then we always say that you should take as much advantage of that as possible. Now to be able to do that, you first need a strategy that gives you the overall loss making trades. The losses should be much smaller than the profit that you make in the profit making trades. The strategy has to be structured like that for you to succeed in options buying, right? When you have a strategy like that, which you can see with the results here, you can do the calculation and you can see yourself. It is important that you make as much money as possible in your profit making trades. Now for that to happen, what we say is, we always say that deploy one capital. For example, for one lot on a first day of the week, you may end up, the premium you might get is around 200 rupees. So we say 15,000 is the minimum capital you will need if you are trading every single day, right? So if you invest that entire 15k capital, what would happen? That's how we look at it. The other reason why we also do it is, whichever strategy you do a backtesting, what you will realize is the total gross profit versus percentage of profit made. If you look at both of them, the percentage of profit made will always be significantly higher than the gross profit you have made. The reason is, when you have smaller entry, the profit that you make with them, for example 57 to 86, the points might not make a lot of sense, but the percentage wise this is a significantly huge percentage. Now to be able to take advantage of that percentage increase, we say that invest the capital always, and hence you will get a better advantage. Now mind you, it is a double-edged sword. When you have losses, in one lot you would have taken 800 rupees loss, but because you are taking 3 lots, because your entry is 59, you would get 3 lots, your loss is 2400 rupees almost. But still, why would we suggest this something like this is because when you make profit, the strategy is already ensuring that your losses are not as high as your profits are. So when you make profit, it gives you much higher return compared to if you just do it with one lot. That is the reason why we say that look at it as a capital and try to deploy. This is not something that we recommend that you do it. It is our thinking process. It's up to you if you want to adopt something like this or not. It's completely up to you. How much capital you invest or how much capital you want to test this with is an entirely each and every person's risk appetite and their own trading style, obviously. But for this example, we have taken thinking, what if we deploy 15% of the capital? Then we have also given you the reason saying we couldn't find an entry here. We found an entry, exited at last high since blue markers kind of stopped, exited. We also have reasons like better exit was possible, but to ensure that we are fair in terms of the data that we are coming up with, we have taken a worst case exit scenarios. We have given you reasons. We would hope that we would be able to follow those reasons as well. What we want you to do is we want you to verify each of these trades, do the backtesting the way we have explained, and see for yourself as to if this is working out the way we are explaining to you or not. Entire month's data, when we look at it, it is really amazing. If you are joined our Discord and if you have joined our channel and our webinars, you have already realized that many people, not only us, our subscribers, many people also give you the feedback that these markers along with opening range are extremely efficient. Now if you follow the rules that we have said, the kind of results we have got is obviously really crazy. However, this is not a P&L. This is only a backtesting data. Okay, we don't want you to get swayed away by this. We don't want to influence you by something like this. We at 915trade.com, we are very cautious with what we communicate. We don't want to give wrong impressions to anybody. Assume what we are saying is, so if a strategy that is probably working out and is giving you positive results, assume you do only 25% of this or 50% of this, it is still significantly higher. So we want you to backtest this. We want you to test this yourself and see if this is something that you can incorporate as part of your trading style more than anything else. We are not telling you saying that you would get this kind of a result. That completely depends on each and every trader and if they are able to execute trades like this or not. However, this idea is to just tell you saying that there is a potential here along with this strategy. Hence, we would like you to take a look at it. The biggest advantage of this backtesting and this advantage is not this return, the 461%. That's not it. The most important thing for us is the number of trades. Any month you look at, we did this for the month of September as well. The maximum trades you would get is 28, 30, 32. That means you are not over trading. You are only taking 30, 32 trades a month, and within that you are getting a decent returns as an options buyer. Now, if there is a strategy that is ensuring that the profit making trades versus loss making trades ratio is good, it is in the favor of higher in profit making shares, and then the average profit made in profit making shares versus average loss made in the loss making trades, if that is also good, if it is 1:5, 1:1.5 or 1:2, then you already have a very good strategy. The idea is to just communicate that and to force you to at least go and evaluate this. You could do a backtesting with the rules that we have told you yourself, or you could simply evaluate these and find out if you think this is something that can be worked out or not. We've tried to be as fair with our rules as possible, but then this is our data. We only invite and request you to please validate this and test it yourself. The rules, like we said, are simple. You look at blue markers at the opening range high and pink markers at opening range low, and based on that you take a trade and then you go to the next trade. For example, if I look at this trade itself, 1st October, the entry was 935, exit was 951, and it was a call entry. 935, 951. 24,650 was the ATM strike. 935 because this was broken here and we have got a triangle, and then we are taking 935 here because after it is broken, one more candle we are waiting and we are taking an entry here. Now mind you, the exit is 951. We have not taken, we could have obviously taken an exit here or here, but there is no way you could exit like that in production, right? Because you're expecting the price to go here. But two very big candles, obviously giving you an indication that it's kind of melting your profit. So we would rather want to exit with whatever profit we have in hand. That is the reason why we have exited in this trade. Now, similarly, with all other trades also, you will see that we have tried to be reasonable with our entries and exits. It is possible that some of the entries could be one candle before, one candle after. Again, we only want you to take ideas from this and see if you can improve it, enhance it, and see if it can fit into your own style of trading. Hope this gives you an idea on how to use this strategy and how effective it is for you to incorporate in your trading style. Again, we sincerely hope that this helps. We sincerely hope that you take it as something that you should test and not as something crazy returns that you would get. That's not our idea. That's not our intention. And hope to bring you many more videos that can help as an options buyers and sellers. It can help us succeed. Thank you so much. Thanks a lot.